So April 2025 question 3. April 2025 question 3, we are told that the management of Taratibu Industries Limited is reviewing the company's capital investments. There are 6 projects under considerations as follows. Project A, initial outlay is 29 million. Project returns are as follows. These are the project returns. The capital, so returns ni kama profits ama cash flows. The capital equipment purchased at the start of the project could be sold for 5 million at the start of the 5th year. So start of 5th year is like end of year 4. That's the terminal cash flow. So you just go one project at a time. Wanataka to calculate the NPV of each project and using calculations advised on the projects to be undertaken. Then calculate IRR for project A, C, and E. So if we start with project A, tunasoma tukifanya project A. Our initial outlay for project A is 29 million. So the figures are in millions of shillings. They have the cost of project. It's 29 million. We don't have any incidental cost. We did not invest in any working capital. Then we have annual net cash flows. Annual net cash flows. Washatutengenezea cash flows zetu za year 1, 2, 3, and 4. So we have year 1, year 2, year 3, and 4. And the terminal cash flows, we have the year 1, 2, 3, and 4. So cash flows zetu in year 1, the figures are in millions. We have 8, we have 12, we have 10, and we have 6. And terminal cash flows. Cash flows always accrue at the end of each year. So after 4 years, at the beginning of year 5, we shall sell that asset at 5 million. Cost of capital tulipewa somewhere. The company discounts all projects of 10 years duration or less at a cost of capital of 12% and all other projects at 15%. So 10 years or below, this is for 4 years, kwa hivyo our cost of capital is 12%. So we need to get our NPV at 12%. So we have the year. We have the year. Want us to year 1 mpaka year 4. We have the cash flows there. So you have the figures are in millions of shillings. Then here you shall need the PVIF at 12%. And we have our present value. We have our present value. So we have another year 4, the terminal cash flow, year 5 million. At the beginning of year 5 is like end of year 4. So the discounting factor, table 1 or table 2?
Table 1.
Yeah, ni lump sum, kwa hivyo ni table 1. Kila mwaka umejisimamia. So table 1, 12%, 1 year. What is the table? So 12% 1 year, table 1. Or you can use the calc, 12% 1 year, that is 0.8929. So 0.8929. Year 2, 12%, using 0.7972. 7972. Year 3, 0.7118. And year 4, 12%, 4 years, 0.6355. 6355. Year 4 ziko mbili. 6355. So we have the present value, which equals to 8 million times the discounting factor. So allow me to drag this, and we can put them into 2 decimal places. So that is our present values. If you can remember, we talked about present value of cash inflows, which is the summation of that. Then we less the initial outlay. Initial outlay, the cost of the project was 29 million. And now that gives us our NPV. So NPV becomes the difference. So present value of cash inflows minus initial outlay. And that is our NPV for that. If I'm too fast, you say. If I'm too slow, you also say. If it doesn't, where it doesn't make sense, also say, please.
Keep warm.
Now, we can actually get the IRR. Because they also wanted us to get the IRR. Now, the NPV is positive, meaning to get the IRR, we increase the rate or we reduce the rate?
We increase.
We increase the rate because it means IRR is greater than the cost of capital. When NPV is positive, you increase the rate and recalculate using trial and error. This one shilling, 1 point something million. So when you are increasing, I always say you just double that rate. So you can put here PVIF. We can do 24%. Just to be safe, when you're increasing, increase it by 2. When you're reducing, just reduce by a half. So therefore 24%, we have it in the table. So 24% 1 year 0. Can see 0.8065, 0.8065, year 2.6504, 6504, year 3 have 0.5245, 0.5245, then year 4 0.4230, 0.4230, 0.4230. Then of course our present value, becomes the cash flows times the PVIF. Cash flows times the PVIF. We have there. Then we add together the present value of cash inflows. We less the initial outlay, which is 29, and we get our NPV, this minus this. So you can see we are lucky. We have a positive NPV and we have a negative NPV. When you're doing AIRR, you need the two NPVs, one with a positive, another one with a negative. And we now come and appreciate kwa IRR. Remember the formula? Equals, we have lower rate plus NPV of lower rate. We divide by difference in NPVs. Then we multiply both sides by the difference between the higher rate and the lower rate. You can remember the formula. So between 12 and 24, the lower rate is 12. So 12 plus NPV, a lower rate, it's always positive 1.82. Divide by the difference in NPVs. Unaanza na hiyo yenyewe 1.82 minus negative 4.85. Then you multiply all that by higher rate, which is 24, minus lower rate, which is 12. I hope that makes some sense.
Yes.
So our IRR becomes 15.27, and that's a percent. %15.27%. So we look at project B. Project B. We were told it would involve a current cash outlay of 44 million on capital equipment and 20 million in working capital. So the initial outlay in millions of shillings. So we have cost of equipment. Cost of equipment wamesema ni ngapi? 44 million. Then we add working capital. Working capital, if you can recall, we said that is part of the initial outlay. Working capital is of 20. We don't have any other incidental cost. And that gives us the initial outlay. Initial outlay, that is 64. Annual net cash flows. So miaka ni 3. So you have the year. Can have year 1, year 2, year 3. The figures are in millions of shillings. So projected returns are as follows. We have sales, variable cost, we have the contribution, fixed costs, profits. The fixed costs include an annual charge of 4 million for depreciation at the end of the 3rd year. The working capital investment would be recovered and the equipment would be sold for 7 million. There's a catch somewhere hapa chini, walituambia to ignore taxation. When you're told to ignore taxation, then that basically means that even depreciation will be ignored. Like now, hii swali, washatufanyia sales, wakaless variable cost, wakapata contribution. Kama wangekuwa wameless, tungeless. Just preparing the normal income statement. Wakaless fixed costs, wakapata profit. Lakini hapa kwa fixed costs, kuna depreciation yenye tunafaa tuitoe. So, we have profit. We have profit. In year 1, we have 15. In year 2, we have 20. And year 3, we have 6. Washatufanyia zote. But now, in arriving at this profit, depreciation was charged. Depreciation was charged. And we've been told to ignore tax. And there is the only time we shall bring in depreciation is if we have the tax rate. Otherwise, if there is no tax rate, there'll also be no depreciation. So we add back depreciation. And we are adding back depreciation because there is no tax. Kama tungekuwa na tax, tunge tax alafu to add back depreciation. Or tunge add to the depreciation tax shield. So add back the 4 million. And now that gives us our net cash flows. So this is 19, this is 24, and this is 10. Then can we have the terminal cash flows? Terminal cash flows. Scrap value. Scrap value of equipment. We shall scrap off the equipment after the 3 years. At 5 million, that is 5. Then we must remember to recover the working capital. Working capital, we had invested in 20. So we have 25. So therefore, we can now have our NPV at 25% again. We have the year. So year 1, year 2, year 3, and we have another year 3 for the terminal cash flow. We have the cash flows. In year 1, we have cash flows of 19. Year 2, we have cash flows of 24. 24. Year 3 have cash flows of 10.
Yes.
And another year 3 have cash flows of 25. The terminal cash flows is after 3 years. Then we need our PVIF. Of course, it's still at 12%. 12% tulikuwa tushapata PVIF yake. Taka miaka 3 tu. So that one. So there we go. Year 3 ziko mbili. And we can now have our present value, which equals to this times this. So you have the present value of cash inflows. So PVIF, and we less the initial outlay. Initial outlay was how much? I can see 25, sorry, 64. 64. And now that gives us the NPV, which equals to this minus that. You're having a negative NPV there. Of 2.99. So still with the same concept, if I want to get the IRR, I believe that you're supposed now to reduce the rate. Because NPV is positive, is negative now. So we reduce the rate and calculate the new NPV, hoping to get a positive. Then we can apply our IRR formula and get the IRR. Here, I believe we can all do that. If you're fine up to that point, we can go to project C. Why it doesn't make sense, please feel free to ask. Feel free to ask. Now, the next project, we are told project C, it would involve a current cash outlay of 50 million on equipment and 15 million on working capital. The investment in working capital will be increased to 21 million at the end of the first year. Annual cash profits would be 18 million per year, at the end of which the investment in working capital will be recovered. So it would involve current cash outlay of 50 million on equipment, on 15 million. The investment in working capital would be increased to 21 million at the end of the first year. Annual cash profits would be 18 million per year, at the end of which the investment in working capital would be recovered. So project C, we've not been told about the duration of that project. We've not been told about the duration of that project. So that basically means that that project cannot be hiyo hatuwezi fanya. So anybody who attempted that, hiyo ilikuwa free marks. We ought to have been given the duration. Tumepewa initial outlay, tukapewa working capital, the investment itaongezeka by 21 million in year 1, no problem. The annual cash profits would be 18 million per year. So per year for how long? So hapo kuna error, so hiyo we could not do it because of the life. We've not been given the duration of the project. So there are some free marks there for somebody who attempted it. And just by writing anything Then project D, it would involve an outlay of 20 million immediately and a further outlay of 20 million after 1 year. Cash profits thereafter would be as follows. So how we are year 2, 3, 4, and 4 to 8. So you can have project D. Project D. Initial outlay. Initial outlay. The project would cost 20 million. So 20 million. So this is the cost of project. Hakuna any other cost in year 0. The 20 million hiyo nyingine inakuja in year 1. So you have annual net cash flows. Annual net cash flows. So you have the year. Can have year 1, year 2, year 3, then year 4 to 8. So 4 to 8. So cash flows. Cash flows. In year 1, we have a further cash outlay. Kwa hivyo pesa inatoka ya negative 20. Cash is going out. Cash is going out. In year 2, we are having 15. In year 3, we are having 12. Then year 4 to 8, you are having 8. We need here our PVIF. Still iko below 10 years, kwa hivyo ni 12%. So 12% 1 year mpaka 3 years. That should be lump sum. Year 1 to 3. We can remember, kila mwaka umejisimamia. Then year 4 is an annuity. Year 4 to 8. So therefore, can we have our annuity? So PVFA of year 4 to 8. So we shall check 12%. How many years? Remember 12% 8 years. Minus 12%, how many years? The duration that is before 4, which is 3 years.
3.
3 years. So in our leakage, can we have 12% 8 years? In table 2. So 12% 8 years in table 2. 12% 8 years, 8 years is upper. Are you saying 4.9674? So 4.9674 minus 12% 3 years, 12% 3 years, I can see here, 2.4018. 2.4018. So there we go, 4 decimal places. So hiyo inakuja hapa. Then we can get our present value, which equals to this times this. Did we have any terminal cash flow for this project? Project D. It didn't have any terminal cash flow, so we are good. So we get the sum of these, and we less the initial outlay. So these are present value of cash inflows. We less the initial outlay. Our initial outlay was 20. And now that gives us the NPV, which is PVCI minus IO. So that is for project D. We finally have project E and project F. This is a long-term project involving immediate cash outflow of 32 million and annual returns of 4.5 million in perpetuity. So project E. Project E. So our NPV will be present value of cash inflows minus initial outlay, as we already know. So initial outlay for E is 32 million, annual net cash flows is 45. So if I put here the year, so let's conclude. So for project E, we have the year, and I have year 1 to infinity. I have year 1 to infinity. So is it year 1 to infinity, we have our cash flows, ambazo tunapata cash flows za 20, sorry, where is it now? 4.5 million. So our cash flows are 4.5 million. Then I can put here my PVFA because it's an annuity from year 1 to infinity. So PVFA, this project has a life of more than 10 years. Kwa hivyo tunatumia 15%. Walisema for projects above 10 years, wana discount na 15%. Kwa hapa chini. And remember the annuity, PVIFA, 15% to infinity is simply 1 over R. So this our answer equals 1 divided by 0.15. 1 over R. 15% to infinity. So you have that there. So can we have a present value, which equals to this times this, and we less the initial outlay. Our initial outlay for project E is 32 million. And now that gives us the NPV. NPV, which equals to 30 minus 32. And finally, F is a long-term project involving an immediate outlay of 20 million and annual returns as follows. So hapa tuko na returns pia washatutengenezea. So finally, project F.
Mwalimu,
Yes.
I think this is okay.
Sorry?
I think NPV is well understood. If others are okay, we can proceed to something else. Mama, is this one another concept, a different concept?
Let's just finish with this one,
Okay.
project F, so that we don't leave this question out. Actually, the question is just asking on discounting. Like now, without even doing it, you can just have explain it and discuss it, alafu tuone kaa tuko sawa. Year 1 to 5, we all appreciate we shall look in table 2, sini annuity. That is annuity, table 2. And remember, it's more than 10 years, kwa hivyo ni 15% 5 years, because it's from year 1. So 15% 5 years, table 2, we shall have our PVIF there. Then 6 to 10, still it's table 2, it's annuity. We shall take 15% 10 years minus 15% 5 years.
Right.
Then 11 to perpetuity, we shall take 1 over r. So there will be 1 divided by 0.15. Then we subtract 15%, 10 years. Because it is 11 to perpetuity. If you do 1 over r, it's 1 to perpetuity. But we don't want 1 to perpetuity, we want 11 to perpetuity. We subtract the unwanted. So you don't want the first 10 years. So you do that, you get the NPV, just like that. That is doable?
Yes.
Great, 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 great. Now, just want us to take one question that has a replacement decision. Tutengeneze tu cash flows zake, because I know once you're able to do the cash flows, getting the NPV, by now it should not be a problem to us. The challenge that we may face is getting the annual net cash flows. Getting the components of cash flows. So let's get a question that is more detailed. Tufanye moja. Question that has replacement decision. Mm-hmm. As machine A, machine B, not replacement. December 2021. So we have question 5 of December 2021, question 5A. So let's have question 5A. of December 2021. Can just do the part of the components of cash flow. So Bob Limited is contemplating replacing an existing machine which was purchased 5 years ago at a cost of 825,000. So I want to replace a machine having used it for 5 years. Ni kama imekuwa outdated, so we want to bring in a new machine to replace it with an existing one. Ni kama trade in. The machine was expected to have a useful life of 10 years and an estimated salvage value of 40,000 at the end of the 10th year. However, if replaced, the existing machine can be sold in the market today at 300,000. So as we buy the new machine, we sell the old machine and get 300,000. The new machine will have an initial cost of 1.2 million and a useful life of 5 years. As a result of increased efficiency that will arise due to replacement of the existing machine, the firm will save 168,000 per annum in production costs throughout the new machine's life. It's per annum, meaning it's annually. And remember, when we save costs, we increase profits. So a polite loan atuambia tutaongeza profits zetu by 168,000 annually. Na miaka yake ni 5. There will be annual savings in reduction of wastages estimated at 80,000. So we're also saving on wastages annually. When we save on wastages, we increase our profit. Salvage value of the new machine is estimated at 100,000 at the end of the useful life. Depreciations on straight line basis, cost of capital is 14%, tax is 30%. So you can have initial outlay. So the figures, you can put them in thousands. So you have cost of new machine. Cost of new machine. So the new machine would cost 1,200, as you can see there. 1,200. We don't have installation cost. We don't have any incidental cost. Yokuwa nayo tungeiweka. So as we buy the new machine, we sell the old machine. So disposal value of old machine. So the old machine can be sold right now at 300,000. At 300,000. Great. And now that gives us the net cost. Net cost of new machine, which is this minus this. Then after that, we need to ask ourselves, are we selling at a profit or we are selling at a loss? So we need tax on gain, stroke loss. on disposal. Are you selling at a gain or you're selling at a loss? And to get this, we take the disposal value. Actually, in our workings, you can remove this working. So that we avoid a lot of writings. Tungekuwa na incidental cost, tungeongeza the cost of the new machine, tuongeze incidental cost, ndio tupate the total cost of the new machine. Then we less disposal value of old machine, and we ask ourselves if we are selling at a gain or at a loss. And in getting this, we ask ourselves, what is the disposal value? Disposal value of old machine. We disposed it at 300. We dispose it at 300, and we less NBV of old machine. NBV of old machine. Straight line method, cost minus salvage value over the useful life, over cost minus accumulated depreciation. So mpaka saizi wakati tunataka kuireplace, what is the net book value? 5 years ago ilitu cost 825 minus accumulatively tumekuwa tuna depreciate on straight line basis, life yake ilikuwa 10 years. So 825 minus, did it have a salvage value? It's estimated salvage value of 40. Cost minus, so the cost minus terminal minus scrap value over the useful life. Our useful life is 10 years. So that is our annual depreciation, but cumulatively, we have depreciated it for 5 years. Cost minus accumulated depreciation. So accumulated depreciation is annual depreciation times the duration. Yeah. So cost minus accumulated depreciation. Accumulated depreciation per annum times the life. Tunatafuta baada ya kuitumia kwa miaka 5. From 5 years ago when we bought it, up to now it's 5 years. So what is the accumulated depreciation up to today? 5 years. So that becomes that. So do we have a gain or a loss? Now a machine valued at 432.5 is being sold at 300. So you're selling at a loss. So you have tax on loss. Tax on loss. 30% of the difference between these and these. So equals to 0.3 of these. And now that gives us net cost of new machine. Net cost of new machine. We have that, and that. Kama tungekuwa na working capital, sijui kama tuko nayo, tutaangalia, tunaiongeza hapo. The machine are expected to have a useful life of that. The machine will have result of this. Hakuna working capital. Ingekuwa nayo tungeiongeza hapa, alafu tupate initial outlay, which is the summation of that. So that becomes the initial outlay. Now, annual net cash flows. So this is an incremental. This is a question on incremental cash flows, a replacement. As we buy the new machine, we sell the old machine. So everything is new machine minus old machine. So I have here the year. I have the year. I'll have year 1 to year 5. I'll have year 1 to year 5. The figures are in millions of shillings. No problem. So we have annual cost savings. Annual cost savings ziko mara mbili. We are going to save 168 and we're also going to save 80. So 168 plus 80. So that is 248. So this one ni sawa na kusema our earnings before depreciation and tax. Ni sawa na kusema the EBDT. So therefore, we less tax, which is at the rate of 30%. So equals to 30% of these. Then we add our DTS. And remember what I said, it's new minus old. New minus old. So can we have the depreciation of the new machine? Cost of the new machine was 1200. Ilikuwa itumike kwa miaka 5 na ilikuwa na scrap value yake ngapi? As a result of this, of 100,000. So we have 1200 minus salvage value of 100 divided by the useful life of 5 years. That is for the new. Then for the old machine, most important about the old machine, we always depreciate the net book value. Ile value tumebaki nayo baada ya kuitumia for the past 5 years. Tumebakisha net book value ya ngapi? Our net book value, which was 432.5. So the 432.5 is supposed to be used for another 5 years. Na salvage value yake itabaki 40. So just as simple as that. So remember, for the old machine, you always depreciate the net book value. Hapo ndo wanafunzi wengi hunyoroshwa. Ile value umebakisha saizi ni ngapi? Umebakisha value ya 432.5. So this 432.5, if you don't sell it, Then the 432.5 will be used for the remaining 5 years. It will be used for the remaining 5 years. So therefore, we have our DTS. Our DTS, which is 30%, 30% times the difference between these. So it's new minus old. New minus old. So which equals to 30% times these. So we have our annual net cash flows. So which equals to this minus tax plus DTS. Hope we are put together up to there. Then finally, terminal cash flows. Terminal cash flows, we have the scrap value. Scrap value of new machine. Imetusaidia kwa depreciation. Cost minus the scrap value, which is 100. Then we less scrap value of old machine, which is 40. So hii tuna less. Na kama tungekuwa na working capital, hapo tunge add the working capital. In our case, it's not there. So we have our terminal cash flows of this minus this plus the working capital kama tungekuwa nayo. So just like that. So I believe tunaweza pata NPV. At that point, the cost of capital is 14%. If I put here my year, I can put year 1 to year 5. Year 1 to 5. And I have year 5. Year 1 to 5, and we have year 5. Cash flow zetu za year 1 to 5 excuse me, ziko hapo, na cash flow zetu za year 5 ziko hapa. And we all know that PVIF of 14%, this is table 2 annuity, this is table 1 lump sum. We get the present value of cash inflows, we less the initial outlay. Our initial outlay pale juu ilikuwa ngapi? 860.25, and we get our NPV. So any swali? I want to use this question to do the discounted payback period and the and Mir so that we finish this topic. So 14% for the annuity year 1 to 5. Nice, you're just here. So 14% 5 years, I can see 3.4331. 3.4331. That is for 5 years. Then 14% 5 years in table 1, I can see 0.5194. 5194. So you therefore have a present value of cash inflows. Kwanza tuko hapa na present value, sorry, which equals to this times this. And the present value of cash inflows, that is the total of that. And we less the initial outlay. Our initial outlay was 860. 860. And we get our NPV, which equals to this minus that. Now, in this question, it's not possible to get the discounted payback period. So let's just write something on a discounted payback period. We shall modify this question so that it can serve us. So discounted payback period, we say this, it is similar to the normal payback period. It is similar to the normal payback period, except that under DPBP, we accumulate the present values. Stroke discounted cash flows. We accumulate the present value stroke the discounted cash flows until their total is equal to initial outlay. Until their total is equal to initial outlay. So let's have an illustration. Na illustration yetu tunaenda kuchukua kwa December 2021 question 5A. So December 2021 question 5A. Question 5A, comma, assuming the initial outlay is Kenya shillings. 600 million. Assuming the initial outlay is Kenya shillings 600 million. Now, to get our discounted payback period, lazima tuweke kila mwaka ujisimamie. So we have our year. We have our cash flows. We have our PVIF, which was at 14%. And we shall have our present value. So we have year 1, year 2, year 3, year 4, and year 5. So for the discounted payback period, lazima kila mwaka ujisimamie. Lazima kila mwaka ujisimamie. So cash flows zetu za year 1 ni 216.05. To 16.05. So year 2 still to 16.05. Year 3 and year 4 to 16.05. But when it comes to year 5, we have more than one cash flow. We have 216.05. And you also have the terminal cash flow, which was 60. Terminal cash flow of 60. So inakuwa cash flows of year 5. Na kila mwaka ukijisimamia, it's no longer an annuity, now it becomes a lump sum. So you check lump sum, 14% 1 year mpaka 14% 5 years. So kila mwaka umejisimamia, that is a lump sum. So 14% 1 year, you can see 0.8772, 0.8772. Year 2, 0.7695. 7695. Year 3, 14%. We're having 0.711, 0.6750. 0.6750. Year 4, 14% have 0.5921. 0.5921. And year 5, we have 0.5194. 5194. 5194. So therefore, present value yetu equals to this times this. So under normal circumstances, kama wangetaka tufanye NPV, tunge add to less the initial out. Now let me explain the difference. The normal payback period, tunge accumulate easy cash flows. Discounted payback period, we accumulate the present values, the discounted cash flows, until their total is equal to initial outlay ambayo tumesema to assume ni 600 million. So therefore, our DPBP, we take our year, then we have our present values, then we shall have cumulative present values. So we start with the year 1. In year 1, we get 189.52. Cumulatively, nitakuwa na 189.52. I need my intention is to recover 600. Nenda mwaka wa pili. Mwaka wa pili, I'm able to get, I can see 166.25. So cumulatively, if I take this, then I add this. So tunaenda mwaka wa tatu. We still need around 240 to recover. In year 3, I have 145. So I put here my 145.83. So you can see the cash flows that you're accumulating. You're accumulating the present values. So this plus this. So you're at 501.6. So I have to go to year 4. Year 4, you have 127 and I need something to do with 98. So therefore hapa najiuliza, how much do I need to reach my target of 600? So this becomes the difference now, this minus this. So I need 98. So therefore, my discounted payback period shall be equals to 3 years plus a fraction of year 4, 98.4 out of a total of 127.92. So as simple as that. And that is our DP.